now let's look at corporate acquisition and valuation. In English, here are all the examples that come with the program. And there you have acquisition. And you take the newer one. Yeah, I guess it's that one, yeah. Yeah. Okay. This is the one you are using in presentations. So. And let's start from the beginning, from input basic values. And open the calculation term, press the button. So we see here is a 10-year calculation. And residual value, if you press the residual value button, so here is by default selected perpetuity extrapolation. I mean, it's going concern then, so eternal cash flows. That's okay. And you also see that some historical periods are included. So if you press define there, we see that it's the year 2010, 2009, 2008, 2007, 4 years actually. 2010 is up also. 2011 it will then be the first forecast year. It's an old calculation. Okay. And cancel. I just wanted to show you this. Yeah. Then we see that there is the numbers are in 1,000 euros, and the discount rate is 2.75, and the cost of equity is 15%, and the corporate tax is 28%. And when making a valuation, so what you need to do is first you need to enter the historical income statement and balance sheet. And based on those, you would then make a forecast for that business forward. So we will now start with entering historical income statement. So you can go to input income statement. And now the historical periods are hidden. So when you press the button a little bit to the right, the last gray button, yeah, that one. Then we see that the historical numbers are there. This means that they are hidden in the example file, by the way. Interesting. I wonder how many can open it. But anyway, you see now there are the turnover consists of sales to different continents and different business areas. And they are then, this is the historical numbers, the outcome from previous years, and they are entered there. And of course, this, you know how to create sub-rows and detailed sub-rows. So you can enter in any form you like, how you want to describe that business. It can be also per product group or per customer or however you choose to model the sales. But here they are in this case showed like this. So they are in practice here, enter those numbers. And then you have down you have some other operating income, and then you have some costs for raw materials and external charges and stuff. So those are like from the closing of books, I mean from the annual statements, and numbers are entered, and then what has been added here is a percentage calculated from net sales, so that you see that how much is staff cost as a percentage of turnover, how much is raw materials and consumables as a percentage of turnover. So this is just to help you then for making forecasts forward. So this is also added manually, these formulas there. And you have some financing costs there. and appropriations and taxes and the historical profits, net income per period in the income statement. Okay, so now the historical income statement is entered, and then you go to balance sheet and you enter historical numbers in balance sheet. So input balance sheet next. Yeah, balance. And now you can open this for detailed view by pressing the gray button left below balance sheet heading. The second one, yeah, you're close now, yeah. This one opens for detailed view, all rows. So you see now here like have been entered 4 years backwards the book values of immaterial rights, the book values of, if you go down, there are some tangible assets. Yeah, there is machine and equipment, buildings and structure, land and water, and so on. So these were the book values, historical book values. Well, the minimum you need to do is the last year in balance sheet so that you have an opening balance. That's at least required. You don't need to have 4 historical balance sheets. And the other thing regarding this these fixed assets is that you need to select depreciation for the opening balance, and that's a little bit tricky. Go to buildings and structures, or machine and equipment. A little bit up. Yeah, okay. Let's look at machinery. So now the opening balance is 134,000. And that's the book value for machinery and equipment. And of course, in a company there is lots of different machinery equipment, computers and machines and whatever. And they are, since they are bought at different moments and they have different depreciation periods, so they have different depreciation plans, and if they are depreciated straight line, then they will also end at different moments to depreciations. So now actually this is wrong, because now when I said select straight line 20%, it will sort of start a new one depreciation plan that will continue for 5 years the same. But this is not reality. In reality, it looks different. So if you have access to the real depreciation plan from the company's accounting, then you, instead of straight line, you choose enter. And then the projection and the formulas we're taking out, and then you can copy the depreciation plan here. They will have, yeah. This is the total then for raw machinery, yeah, exactly, yeah. And if you don't have access to it, like you very often don't have when you make these first calculation rounds, then you can cheat. If you, instead of enter, you choose declining balance. And instead of 20% straight line, you put 30% declining. So enter 30 now. So what you see is that you have then a falling. So you sort of try to simulate the same. Yeah. So that was just a trick. And then when it comes, if you think about buildings, let's say this 650,000 consists of only 2 buildings in this company. One worth 400,000 and one worth 250,000. And they, of course, then had their own depreciation plans each. Then you could also choose, instead of putting them here, you can put them in the investment table as old old investments, as it is called there. Let's put one of the buildings. Let's reduce this one to only 250. Yeah, 250. Yeah, and then we put 400 in the investment table. So we'll go input investment. And we use the third line, we call it old building or existing building. Existing building, a good, yeah. Yep. And then you press the depreciation button on that line. And we need to have more options visible. Top right. Yep. And there in the middle now came this old investment, mysterious tab, yeah. And now we can continue the old depreciation plan of the building. Let's say it was, let's first change depreciation time to 40 years. The time, depreciation time is top left. It's 10 years now, but let's put 40 years. Years. Yeah, 40 years. Yeah, you're gonna just enter it, it will change. Okay. And then, okay, no, back again. No, this depreciation button. The third depreciation button. Yeah. We weren't ready yet. You pressed enter. Okay, by mistake. The button. Yeah. Okay. Now we have this 40 year, and then all the investment. Continue all depreciation plan, and then let's say that this. This will be difficult, by the way. Oh yeah. No, let's make it easy. We take. But it doesn't matter. We put a purchase price of 600,000 and purchased in 04/2008. Okay, so now you see that there's still a book value of 558,750, and there's still 37 years left to depreciate. So that's how it works. So when you press OK now, we will see that we have. Okay, if you switch still from this, this outline on the top where it shows number 3, if you switch from 3 to 4, so the book value of the existing building, you see how it comes to the calculation. Of course, when it shows here, it also shows in the balance sheet, and then the depreciation show up here. So now this specific asset has its own depreciation plan here in the investment table on one row. There's no investment, but there's the book value. And if you go now back to the balance sheet, input balance sheet, and building a little bit lower. Yep. No, we went too far, I guess. Yep. So, okay, there's one mistake still. It shows up in machine and equipment, so we need to go and change. And also it's in thousands. So let's go back to investment table. We made two mistakes. It was my mistake. Input investment. And then the same button again. And first let's change from all investment from 600,000. Let's put 500. Okay. And then we also change type of assets from machinery and equipment to buildings and structures. It's left down. Yep. And then okay. So now it will be better. When we go to the balance sheet and look at the buildings book value. So yeah, now it makes sense, you see. So the first row specified refers to that we have made detailed specification of it in the investment table. And also that's on that row that the new investments always show up. So then they are summed together. Yeah, that's nice, by the way, overview. And we have the current assets, we have the inventories, we have the accounts receivable, we have other receivables, and then we have equity and liabilities on the other side. And they are entered here, the balances of those posts, and some of them you need to sum up, like if you take like okay, now it doesn't show for input when you're level 4. If you switch level 5 again, then it will show also the yeah, in outline. Yeah, exactly. Yeah. So if you go to short-term liabilities now, it will see you will see the most detailed input that is available, and you notice that yeah, let's say other interest-free short-term debt 281 would probably be summed up from several items on in a balance sheet in the financial statements closing of books. This is not as detailed. Like here it's summed up also. Exactly, yeah, like that. Yeah, good example. And now this difference that shows up in red because the balance sheet doesn't balance is because I made a change in the building. So it should be sort of balanced on the other side of the balance sheet also. Yeah. You can of course now adjust it by you see the difference. So you add to, let's say, depth that much more depth. Interest bearing long term. So in 2008, no, it's maximum now. You closed it now. So this 301 you can increase it 491. So 301 plus, okay, you did it directly. Yep. And now you see how to do for next one also. You can, it's Excel. You can do it in the cell. You can do it in the cell. It's Excel. Yeah, and then equal before or plus whatever. Mm. Yeah, if it would be this is in reality, but yeah, and now we have entered the historical balance sheet, so now we can start making forecast, and we can start from the investment table. Because we know it's the top sheet, so we start there. And first of all, in this valuation model, the first row is sort of marked or reserved for the acquisition cost of shares. But if we now take it step by step, and let's say we first make a valuation of the company before we enter a buying cost. So let's delete this 9,000 now. Then it would be like any investment calculation, basically. Okay, that's it. And then the second row, annual capex, gives a clue what it's about. So the normal investment level planned for the future, like 100,000 annually with 4% growth. It seems to be so. So that's what we forecasted, that business as usual requires investments. So they have been entered there and simplified, all with average 5% depreciation plan, 5-year depreciation plan, 20% plus this building that that's good for now. We have made a forecast for coming investments, and then we move forward to next screen, which is income statement. And now we have historical numbers, and now we need to make a projection forward for how sales per business area will develop. That's simple. You just have some view of how it will be developed. Let's say you select Europe business area 1 in 2010, this 15,556. You select that cell, that one, yeah, and then copy distribute button. And how would we expect, let's say this business will grow 3% annually. And distribute. And off it went. So you plan the sales, and then the cost you base on the percentage of sales. So you see, like for historical years, the cost of raw materials was entered as a number, and then the percentage was calculated. Now for the future, it's vice versa. So you enter the percentage, and the cost is calculated. So this 86% represents some sort of average, I guess, or most likely. Yeah, it's entered, and the other one is calculated then as a percentage of sales. And the same goes for the other cost items. So we assume that the cost ratio is the same, or if we don't assume it's the same, then we choose another percentage. But of course, this is just one way to do it. It's a simplified way. Of course, you might need to be more accurate. But this is one way to do it. And so that concludes the sales and the costs forecast, and then we come down to financing. And Okay, depreciation comes automatically, of course, we have done that, but financing, actually we could even forget about financing at this point, because remember, it will not change the value. Financing items will not change the net present value, will not change the IRR, will not change the payback, unless we look at the equity cash flow. But actually, by default, when we evaluate the company, you made it on the, but you also use the weighted average cost of capital and look at the free cash flow to firm. The same way as with investments. That's the normal way to do it. Then it's different if it's a small company and it's the owners making the calculation. Then they may look at the return on equity. But large companies, it's the firm's point of view that is the interesting thing. So basically, what is here entered and obviously just copied out, so it's not necessary at all. And then this row net result, the last yellow row there in the financing fields is just, for example, put one extra intermediate sum to show how you can make your own sub results. Yeah, well, actually, no, don't do it. Take cancel. The last one is already made as an example. It's called net result, and it's, yeah, that's right, yeah. So it's just put here as a demonstration of how you can put your own intermediate sums. If you miss something in the invest for actual income statement, you can add your own sums here in between. That might be needed for some specific ratio. Yeah, if you double click it, I mean the 786 cell, if you double click it, it shows what it consists of. And this is just something that is made manually, just as an example of how you can create your own ratios. And actually, I guess it's made here because it's required for some ratio in this financial ratios part, which we have added in this example. So some ratio is based on that sum, so that's why it's added. So you see, it does not. Oh, tax is deducted, yeah. So it's like a result after financing costs, but including taxes, yeah. After finance and taxes, but not extraordinary items. Just an example on how you can go around about if you need something specific. Okay, then I guess that concludes the income statement, and let's look at next screen. The working capital. Now you see also for the historical periods what was the average term of payment for account receivable. It was 5, 6, 5. Now we use 7. Okay, so you can have some reference for future views 1 week. And then inventories. Last year it was 31 days. 2008 and 2009 it was 41 days. 2007 it was 51 days of operational costs. So now we assume that it gets a little bit more efficient, 30 days, and it calculates 30 days of variable costs as a basis for inventories. And then we have accounts payable, we see also what it was historically we have been paying to our suppliers with those terms of payments, and now we assume 30 for the future. So we have then the net working capital of roughly $1 million and increasing then when sales increase. Okay, then next screen. Now we can hide the historical periods because they make no sense anymore to be included. So you can, do you remember where you hide historical periods? Yes, that's where. Okay, so now we had a free cash flow to firm. So it will generate a free cash flow annually of 600,000, 700,000, 800,000, 900,000, 1 million, 1.1 million. So this is what we believe. And this is the cash flow that the valuation will be made based on. And next screen. Now you can minimize the, close to detailed input, so you can press the gray button to the left below balance sheet. The other one, yeah, that one. So we have a better overview of the balance sheet. But the balance sheet takes care of itself. All the changes come from the other screens, so we don't have to do anything here. Yeah. The blue ones, we come back to the blue rows. We are not looking at those yet. It's next phase. Next screen. Key financials. Here are some examples on how this page can be used. So here are some ratios. Enter the name and then an Excel formula. Of course, when you make a valuation, they are important to see, to compare to other similar companies. So these are common ratios. And we come to the result sheet, and now we have the valuation. So we have this present value of operating cash flow, 8,779,000. So this is 10 years of cash flow. And then we have the residual value, 16 million. That's what happens after 10 years. And in this case, now the open one is limited to 20 years, not perpetuity, but 20 years. So it's extrapolation of 20 additional years, so total 30 years. But you can, and it's based on the last year's free cash flow, 2020, which was 1.1 million, 1,141,000, and growing by 2% annually for 20 years. But this can be changed. If you don't want to use 2020, maybe you think it's a too good year, you want to take another year, you change to another year. Yeah, that's where you do it. Let's say 17 is a typical year, or 15 is fine also. Yeah. And or if you don't want to base it on a specific year, or you want to base it on a specific number, then you can choose enter annual value and enter value. To the left, there is, instead of net cash flow for a year, you select enter. Yeah. And then you can, let's say you enter 1,000. 1 million is a typical year. Thousand, yeah. And now it will be based on that value, the extrapolation. And if you don't want to have a growth, actually we don't have a growth now. no growth is selected. But if you want to have a 2% growth, then you select growing by, and it increased the residual value because it was with 2% growth. And if you don't want to limit to 20 years, you want to have a perpetuity, then you change from 20 to, it's actually the first one is the perpetuity. Yeah, perpetual. Okay, now we got the huge. Oh yeah, and I know why we have such a big number, by the way. We have such a low discount rate, only 275, which is not realistic. We should go, and it's because of the demo version we have this 275. So we should change it to what, 10% maybe. So go to file, now input basic values. Then. And now let's look at result again. Result. Profitability analysis. Okay, now it makes better sense, yeah. It's even less than the first 10 years, but it's okay. Very often, I will show you one more detailed trick. Very often, now if you change first to 2020 again, this drop down, to the left, this year, that one, yeah, 2020, yeah, okay. And then in the formula where you have this enter annual value, where you enter this 1000, if you go to that cell, the gray cell, yeah, and then equal, and then you point to this 1141 and multiplied with 1.02. Yeah, and enter. So what I did now was I created sort of like the 11th year. This is how it very often is calculated, this terminal value, residual value, so that it's not based on the 10th year but on the 11th year. And now we sort of created the 11th year by taking this 2% growth also on the 10th year. Do you follow me? Just the base value, yeah, yes, it was like I included 2% inflation also, because this 1141 was the 10th year, but now we have 1164, which is sort of the value that it would be on the 11th year. Because otherwise, how Inverse calculates is it assumes that the 10th and the 11th year are the same size, no 2% growth. Yeah. Because the perpetuity value is always calculated on the 11th year. The next year following the last year. So if you have 5 years, it's the 6th year, or if you have 15 years, it's the 16th year. That's my point. So this was also like extra course. But anyway, one interesting thing. Okay, first let's explain what is 8% discount rate to the right. It's really 10% discount rate, of course, but the terminal value is calculated using the Gordon formula, which is basically the cash flow per year divided with discount rate. So this would be 10% if there would be no growth, but when there's a growth, it's discount rate minus growth that is the cash flow divided with. So actually this value 14,553,000 is 1164 divided with 8%. So I mean You can try the calculator. This is how companies are valued. One number divided with another number. And no, it's actually this particular case it's 1164 because we have selected that one. 1164 divided with 0.08. Yeah. Also just for information. Then this 14.5 million, 14,553, of course, will be discounted to this day. And this day is now beginning of 2011. So we get the 5.6 million in today's money. Yeah. And that's the same number as you see in the white cell above. Your present value 6 million of 10 years and then present value 5.6 million of the rest. That's the terminal value. And those two are added together, and below the yellow you see 11.6 million, which is 5.6 plus. Yeah, that's what number. And by the way, above that one there is something called implied exit multiple 7.93. What the heck is that? That is that this 14.553 that we calculated as a terminal value, that's 8 times last year's EBITDA. So we value it to be paying itself back in 8 years. And these are the multiples that are used for valuing companies. Let's say it's a meat company. Meat companies usually use 5 for multiples. Or let's say it's a chemical company. Usually industry uses 10 as a multiple. This kind of, because this is, you can compare companies side by side that way. It's very simplified to calculate the value of a business in your head immediately. I mean, why if you have two, if you have 5 listed sausage companies, and they are very similar. So why would, if they make about the same profits, so why would one company be valued at 15 times EBITDA when the other one is, all the other ones are valued at 8 times EBITDA, roughly, by investors. So it's a help in that sense. Okay, I'm talking a lot. Then yeah, then we have the present value of business cash flows 11.6 million. We went and then we deduct, and this is a little bit odd. Here we deduct the present value of the investments we made during these 10 years. So we had this 100,000 per year, 4% growth, new investments. So this is the present value of those. So now they are deducted. So now we have the final present value 10.9 million. It could have been on top already in this 6.5 million we had at the top. But if you really 6 million, yeah. But it says operative cash flow, and operative cash flow does not include investments. So now the investments show up here below, and now we have the present value of cash flows, 10.9 million. It's just where you put it. Anyway, 10.9 million is now the present value, but it's still not the value because this company has debt. So now we deduct the debt. The interest-bearing long-term debt, 1.4 million is deducted. The interest-bearing short-term debt, 100,000 is still deducted. And we have some money, we have 11,000 on the account. This is added to the value. But then here I made some manual adjustments. Maybe the buyer also knows that this company owns a yacht worth 100,000 and it's not needed for the business, that it can be sold immediately at that price. So we take that also into account, increase by 100,000. Then the sellers still want to have some dividends before it's sold, 300,000. Okay, that's deducted. Then we think that they don't show all the possible liabilities in the balance sheet. There are some, maybe there's some lawsuit coming, or maybe they're too optimistic about some what's it called? That somebody owes us some what's it called? The opposite to liability.
Receivables.
Receivable, yeah. That's anyway. We make some adjustment here of 700,000. There's some hidden liabilities in the business. Exact. That's what I mean. Yeah. So this is manual, and then after that we have this free cash flow based equity value. Equity value. This is the value if our projections are correct and the adjustments are correct. 8.5 million would be the value for this company. So if we are buying, we don't want to pay more than that. If we are selling, this is what we want to get at least. And again, to the right, this based on EBITDA, what year does it offer? No, this should be 2010. Change to 2010. Yeah, this was the last historical. Okay, so now we see it's 10 times EBITDA 2010. So we are paying like 10 times EBITDA. We expect that it pays it back in 10 years, which was a little bit higher price than we valued the residual after 10 years, which was 8 times. Yeah. So they're the same thing, but the other one was for the terminal value and this one is for now. Yep. But okay, this is still just the valuation. So phase 1 was valuation. Now phase 2 is to look at it as an acquisition. So let's say we pay 8 million. So we go to the investment table and we put a price for the shares of 8 million. Input investment. Exactly there minus 8,000. First cell. First period. First, yeah. Minus 8,000. Because this first row was reserved for the share of the prices. Actually, if you go to the depreciation button to the left, you will see that it's down left. There's a selection marked corporate acquisition. So there is no type of asset. It doesn't show in the balance sheet of this balance sheet. It will go to the group balance sheet as an acquisition. This was pre-selected. Now you can take cancel. And okay, we assume to buy the whole company now. So if you go down, the first blue rows show now group investment 8,000 or 8 million below. It's in blue color. Blue color means it's group. It's not this company that we are model, but it's the company buying. They spend 8 million on this, yeah. And a couple of rows down, we have marked that they buy 100% of the company. It's also in blue. But then there are some black numbers. Black numbers because this is not group. This is the company that we are buying, the equity in the company we are buying. There was a share capital of 56,000. There was retained earnings 1.3 million. There was profit from the period 651,000, and there was a depreciation difference of 183,000. So this together, the sum is missing here. Actually, if you select those numbers, Excel will show the sum exactly. Now down you see sum 2.211. So that's the equity in the company we are buying. But since we are paying 8 million, it means that we pay 5.8 million more than the equity we get. So 5.8 million is like goodwill. Yeah, because that's how much more we paid than what we get. Because that's equity is like the retained earnings, the capital in the money. But we pay more because we know that this company will earn more in the future. So according to US GAAP and IFRS, the investor wants to know what are we paying for. So that's why you can then allocate to some specific assets. So if you go a little bit down, yep, stop. Oh, let's see. Change the outline from 4 to 5 on top here. Nothing changed. What if you press open this allocated row value before tax? There's a button. Yeah. Oh yeah, it was just closed. Okay, no problem. So 1 million, we say we capitalize development work done before but not activated. So work has been done, it's taken as cost, but there is not put in the balance sheet the value of the work. We say it's worth 1 million and we put it in the group's balance sheet and we depreciate over 5 years. And then we also assume that the market value of the buildings is 500,000 higher than the book value of the buildings. So we increase the value of the buildings. And this way we can continue by pressing the plus, we can put more items here. But the rest, the things we can't tell the investors what we are paying for, the rest is goodwill. In this case, 4,340,000. That's how it works. Actually, this is the difference between current market value and book value. Yeah, so how much you increase. And if you press plus, you see the balance and there's a plus button to the left. Yeah. Then you get one more item visible. And then you get to select from the drop-down menu. Yeah. Let's say that there is immaterial rights. It's the brand value or customer base value. We value it to 1 million. So we enter 1 million. And then let's say we depreciate it in 5 years also, that it pays it back in 5 years too. So now you see that if you go down, that there is goodwill. Yeah, we reduced that. Yeah. So now this is for information of the investors now why we paid, but we couldn't explain it all. But the rest is goodwill. But the goodwill needs to be tested. That's the impairment testing for. That's what it's used for. Is it too much or too little? I mean, not too little, but is it too much? That's the question. Okay, and then there's acquisition financing. So actually, this is now the buying part, the group, if they want to take debt for the acquisition. So this is modeled here. And you have the button, the small button with 3 dots. Yeah. Yeah, the percentage is then it works with majority, so 51 works, but it's still you would have to um, you would have to to adjust the value in the result sheet and with your percentage. It doesn't. I mean, it shows the whole company value. If you buy 51%, you need to take 51% of that to your goods. So actually, now I'm thinking, how would I then do it? Yeah, let's try it. You need to close this one then. It's right there. Yeah, yeah, yeah. But it's if you look at the result sheet now, I think nothing changed there. Yeah. So you see now you you paid 8 million, paid 8 million for the whole company. So yeah, but so it's just, but it's easy anyway in the end. I mean, it's 8207. So 51% of that would be yours. So you would pay a maximum 51% of that whole company. This is the whole company. So you have to take your own percentage into account separately because we value the whole company always. No matter what you how small share you buy of it, you value the whole company. Yeah, yeah, exactly. Mm. I would so also. Yeah. Yeah, exactly. Yeah. Okay, still if you go down now a little bit back to the financing, yeah, that one, and you press the button again, the financing button, that one, yeah. So this is basically the same that we did earlier today when we financed the bottling machine, except here is one shortcut, this enter choice, where you just enter loan amount 3 million, repayment term 15, total financing cost 6, equity 1 million, and press OK, and it calculates a simple repayment schedule here, which is shown here in blue. The other option, if you go back there to the same button, is to select use financing file, and then you know how it works. Yeah. So yeah, cancel.